Hello, everybody. As you can see, we are one man down, so to speak. So that would mean that we'd like more audience participation by about 33% than we would have had before. So if you have any questions at any point in time as we go through this, please do raise your hand or get somebody's attention, rather, because we might not see your hands, to be fair. Our panel today is about unlocking the European capital markets. How do we go about doing that? How do regulators go about doing that? What have they done so far? Is it working? Is it likely to work? And we have a very strong group of panelists who are all very active in slightly different sectors of the capital markets, who can talk about their experiences. We'll let them introduce themselves in a second. My name is Odi Lahav. Should have introduced myself earlier. I'm the CEO of Allenbridge, which is a combination, an investment consultant focused on both the institutional markets in the UK as well as retail markets, particularly tax-efficient investment in the UK as well. And from what I can see, there has been a very substantial, large structural change in the capital market. So this is in Europe in particular, and that is the topic I would like everybody to cover off the bat. But at first point, could you all introduce yourself briefly and just tell everybody what you do in 30 seconds?
Thank you. Good afternoon, everybody. My name is Michael Berry. After pretty well a lifetime spent in banking, mostly in the leveraged finance product. In fact, to add a little bit of human interest, I did arrange the original buyout for the Principal Hotel Group, which owns this business, this lovely set of rooms here, back in 1995. But after that very long career, I moved into a unit of the American Prudential Financial Company called Prudential Capital, which is known as Pricoa in this country. And what we provide out of the huge range of investments that Prudential Investment Management manages for its parent and for external investors is direct private debt. So I felt a little bit when I was invited to come here today that I was coming here on false pretenses because, in a sense, I'm not part of a capital market. What I do is, as I said, direct. It's between me, the lender, and you, the borrower. But then I got to thinking about it again, and I realized that, of course, everything we do is benchmarked against and referenced against what happens in the public markets. And so I suppose I feel a bit more comfortable about being here as a result.
And then they added the topic of regulation as well on top of that. Jim?
Sure. My name is Jim Galowski. I'm a partner at Apollo Global Management. I've been managing risk and people who manage risk since 1985 in New York, London, Southeast Asia, New York again, and now I'm just recently moved back to London. And I co-run the global corporate structured credit, or the global structured credit business at Apollo.
Great. My name is Mathew, Cestar. I'm a managing director at Credit Suisse. I look after our credit business in this region, the EMEA region we call it, and also am the head of leveraged finance at Credit Suisse in this region.
Okay. As I said, from where we sit as investment consultants and what we've seen with our client base, the market in Europe has changed dramatically over the last few years, particularly as a result of bank disintermediation and all of the innovation that's gone around provision of debt, both from a technology standpoint, but also from a private placement standpoint. And the part of the topic here today is to talk about the European Capital Markets Union and what Europe is trying to do to harmonize its approach to the capital markets and to basically make it work more efficiently so that it's a bit more competitive, particularly with the North American market, and to also try to make everything more efficient and by lubricating the capital markets and being able to provide finance to companies that need it. So, but before we get into that topic, I would like to probably set the scene and ask each of our panelists their view of the current market environment, and in particular, where they see potential risks and pitfalls. And Jim, I know you have a few slides, so why don't you kick us off?
I'm not usually the guy who gets the slides ready, so feel a little bit embarrassed, but what I did was I took a bunch of slides from different presentations that we've gotten from various people like Matt and his firm and plagiarized them. This is one I think is interesting. It just shows the difference between the end of 2014 GDP in the US versus Europe, actually quite similar. You can see 17 billion versus 18 billion. But then what's the overriding difference between the two? You can see that the banking system in the US only had about 15 trillion in assets on their balance sheets, and Europe 45 trillion. And I think that really sets a lot of the market when you think about what the CMU is trying to do, which is open up the capital markets to non-bank lending, particularly post-financial crisis. The problem with that is that there's been a ton of regulatory changes that have happened, and granted, they were all presumably put in place, with the right intention. But unfortunately, I think a lot of them can be confusing, and often they give rise to unintended consequences. These are some of the ones that I think have affected in negative ways not only the European, but the US market as well, but in particular, European banks doing business in the US, as well as the difference and, if you will, the inconsistencies between the US and European regulations, and even in Europe, the differences between the different countries and the way they've adapted them. And we can go through all these later on, but the ones clearly that come to notice are those that really were meant to prevent too big to fail, and to make sure banks and others had skin in the game. And like I said, a lot of them I think are more confusing and quite often have unintended consequences. This was one I thought was interesting before the financial crisis, up into the financial crisis, and I'm sure Mathew could speak a lot more to this slide than any of us. It's the amount of high-yield bonds that were held on bank balance sheets in the U.S., and you can see the precipitous drop and the continued increase in issuance. So the big difference in the U.S. has been not only with high-yield bonds, but with senior secured or leveraged loans, has been retail money that's come in and really taken and absorbed a lot of that, a lot of what the banks had been owning in the past. Whether that's a good thing or a bad thing, we can argue that and discuss that in a number of different ways. I think one of the bad things is that it's hot money, and hot money, unfortunately, is not a stable market participant. It's difficult to understand who and what prices will do in an asset class that has daily liquidity, and in the form of ETFs actually have even more than daily liquidity. Mm-hmm. So that this chart here just shows that the real only real money investor in senior secured loans is CLOs, interestingly enough. And the interesting thing about the European market, as I'm sure most people know, UCITS are not a qualified investment, do not consider senior secured or bank loans to be a qualified investment. So there is no retail, if you will, to take and absorb the event that there would be a greater issuance than there is today. A perfect example of one of the results of Solvency II, which is very inconsistent with what the European Commission has said they wanted to do by opening up the capital markets. They have basically, through Solvency II, completely destroyed banks' appetite to take any asset-backed securities or CLOs on their balance sheet. And I think that's probably one of the reasons why we've never gotten back to the pre-crisis percentage of outstanding CLOs here in Europe as they have in the U.S. The other and last slide, one of the real crazy new initiatives in the U.S. has been the Federal Reserve and the OCC putting lending restrictions and leverage restrictions that banks are allowed to issue, but non-banks are actually allowed to come in and make those financings independently. Now, whether that's a good thing or a bad thing, it all depends naturally on how qualified those people are who are actually doing the origination. And I could say I'm sure Michael will have something to say with respect to private placements as well, but you need to have an educated investor to be able to do that.
Yeah,
I think
from where we stand, I'm not sure, is that over to you already?
Yeah, that's good.
From where we stand, there should be a lot more names in that left-hand box. And from what we've seen and the amount of course, everybody's logos would have had to be smaller.
Yeah,
but,
hey, that was the only advertisement. Come on.
Fair enough.
And I had my competition up there.
You did. And a lot of the sponsors of the Milken Institute. So fair enough. After you, Matthew.
Just a couple thoughts on the markets. And my lens here today for this discussion is really about the leveraged finance marketplaces, which has been one of the markets that has benefited from the structural shift that Odi talked about. So that movement away from a sort of a bank-led, relationship-led, non-market-based pricing mechanic for moving credit into the system. And where we stepped into now in Europe increasingly has been a capital markets-driven sort of arena, both in the investment-grade corporate world, which I can touch upon, and then I'll focus in this conversation really around leverage finance. Some of these charts just really illustrate this. I won't hit all of them. Top left is around the euro area bank assets as a percent of GDP. So we're seeing a precipitous decline in the amount of leverage in the system, the so-called bank deleveraging, since the last 5 or 6 years. So over nearly 350% of a leverage as a percent of GDP in the bank markets. Now it's dipped down to 300%. If you compare that to the U.S., and the U.S. is not right in all respects, clearly, and maybe Europe doesn't want this, but the U.S. that number would be about 85%. So if you look at the percent of bank assets as a percent of GDP, about 85% in the U.S. Because we've had this shift in markets, what you've seen is a very sharp uplift in the high yield market as one of these markets, and you can see that on the top right in terms of what some of the annual growth is. And so it's 4 to 5 times amount of issuance that we had 5 or 6 years ago. And you compare that just to tie it in with the U.S. marketplace on the bottom. So the CAGR in the U.S. is kind of 8 or so percent in the last bunch of years as there's been a move towards yield assets, and given all the quantitative easing in the U.S., compare that to the European marketplaces where growth has been nearly 30%. So very, very strong growth. And so this is one of the building blocks for this capital markets union, and you can see the evidence here in the marketplace. If you look at, in terms of some other data that kind of supports this thesis, look on the top right, one of the things that we're focused on, and we should talk about in this forum, is really globalizing these markets. I think one of the issues that we have in Europe is that sometimes historically have been marching to its own beat in terms of structure, documentation, regulation. One of the things we would argue is actually having those harmonized somewhat globally will really aid market growth. And I just picked one market here, the institutional marketplace for cross-border deals, and you can see the tremendous growth here. So these are cross-border deals, Europe into the US or vice versa, European companies financing in this geography, and we've really driven sort of harmony between those two markets. And look at the growth there. My eyesight's not so good anymore, but I think it's over 50% CAGR. And so when you think about Europe, Europe has been in kind of a recessionary or no growth environment. People ask us, where can you find growth? And look at these institutional marketplaces here for the big cap deals, and that's grown very, very sharply. You can see that also expressed here on the bottom side of this slide, which is an over-reliance on the traditional banking system. And so this is looking at some of these institutional deals and pro rata deals, so i.e. those pieces that go to commercial banks pre-crisis or kind of at around the time of the crisis. Again, 85% of this marketplace was really going to the bank community. And now you can see that it's over about 50% of it or so has been institutionalized. And so massive theme on the big cap deals. I'd also suggest this is happening in the mid-market and SME sector, which is a real institutionalization of these marketplaces. And on the bottom right, just to give some validation, third party, I think it's good for Europe, it's good for companies. And what we're really trying to do, and I think at the heart of the CMU, is really trying to drive growth for this geography, really trying to drive employment, and really trying to connect what's happening between sort of pools of capital savings and this growth. But the outsider's perspective is, are our investors being rewarded? Here I just gave some of the stats in terms of the performance of European loans versus US loans, institutional deals that is. And you can see very strong performance over the last 4 or 5 years, and in fact it's outstripped the US, which I think people would find that quite surprising. So some comments to kind of lay the groundwork.
Okay, so I mean we could jump in lots of different directions from all of those comments, but I guess what I'd like to do is I'd like each of you, if you could, just to comment on what you think the major risks are, because as from the work that we've done, we've seen liquidity risk has become a major problem as the banks have retracted, and they have had, they are the warehouses of risk and the market makers. And as they've retracted and private pools of capital have come in, it hasn't really replaced the banks, and that's why we're seeing a lot more volatility. The nice thing about bank loans is that you can amend and extend if something happens. You have a relationship with an individual. If you're issuing debt in the high yield market, it's all public. What does that do with increased volatility and decreased liquidity? Those are just two of the themes that we're seeing in a vast array of themes that what has happened to the structure of the market is causing quite a lot of risk, and there's a lot of money chasing it. So, Michael, maybe we can start with you and kind of the private placement perspective.
Yeah, I think the private placement market, if that's the right word for it, is somewhat different from the ones that have been described on the left of me, on the right of me, as you look at me, in that we tend to be there when the other forms of financing are not really available. We made out like bandits in the post-crash years, 2008, 9, and so on. And right now, we're finding the competition a little tough. And that's because everyone's piling back into our market. And I hear the conventional wisdom that banks are out of it, but they're certainly not out of it in the private in competition with the private placement market. It's one of the biggest negatives in my life that so often companies choose to do a bank deal in preference to a private placement deal. And we can offer them 10, 15, 20-year money, but companies are going for 5- and 6-year bank transactions on what look to me like cutthroat margins. And what I'm gathering anecdotally is that banks are so determined to get ancillary business, which doesn't have capital requirements, they are using the loan product as a loss leader.
Okay.
And I don't know how the capital ratios and the Basel III and so on enable them to do that.
Can I stop you there? Although you may be in different parts of the market, since we have a banker with us, respond to that. Cutthroat margins, you're not making any money, providing financing too cheap.
Yeah, so my comment would be that so we're seeing this institutionalization of the big cap deals. So some of the data that I've walked through here, I think we're seeing a very similar sort of phenomenon in the mid cap deals and smaller deals. And so again, I don't know your business model, exactly, but institutional investors stepping into the shoes of regional lenders is kind of one of the big themes we've seen. You've seen this very significant proliferation of sort of mid-market lenders and direct lenders, and Apollo has a bunch of different sleeves for that activity. So my contention is this is not going to replace traditional banking in this region, because that's been not just decades but centuries of experience in this geography, but it will complement that. I think what we're finding in these markets is generally the institutional market has provided a better solution. So it tended to be either, depends on what you like, but whether it's a longer tenor or more flexible covenants. And then since this quantitative easing move, you've also been knocking on an open door because of pricing has been reasonably attractive. And so in certain situations, sure, will there be competition with the traditional sort of regionalized banks? Of course. But it depends on the flexibility that the borrower, the borrower needs.
Jim, is there a CLO perspective to this as well?
No, look, there is a very small CLO product that specializes in SME type of loans. Honestly, I'm more in the broadly syndicated. I invest more in managers who do broadly syndicated senior secured loans. It's what I know better. But I would definitely agree with what Mathew said, is that there's quite a few people who, like us, and we're not very big at it, but there are others that have gotten in early to be direct competitors of Michael's business. And I think one of the, I think a lot of this has to do with the fact that before 2008, most people in different parts of finance didn't really understand how interrelated each of them were. I think that the managers or the owners of private equity firms probably had no idea what type of ramifications for private equity were in store when the asset-backed commercial paper market dried up in 2008. And what happened was leveraged buyers, a lot of them sponsored by European banks who the BIS told to buy AAA-rated ABS securities that, frankly, they didn't really. Maybe they didn't understand, maybe they were rated wrong, maybe there was malfeasance, who knows. But the point is I think now, post-crisis, there's been a lot of vertical integration, if you will, from PE shops buying credit managers, expanding the business, understanding, creating and taking advantage of permanent capital sources, whether they be listed companies in Europe or REIT structures in the US. And I think as a result of that, I think you're seeing exactly what both of my colleagues here are referring to. The risk, though, the risk is that you have hot money coming into products and people don't understand what they're getting into. And that's what happened 2006, 2007, and it's inevitable that it'll happen again.
But the hot money is in specific sectors, right? There's very little hot money at the high end of leveraged finance, I would think.
Well, the hot money in leveraged finance is in daily, it's in overnight mutual funds that have daily liquidity on an asset that could take 30 days to settle.
Yeah.
So that's a risk. The risk is rising interest rates, and can highly levered companies pay the debt load 300 basis points higher? But
floating rate notes don't protect you from everything. No, except that. I mean, so as you look at the structure of the capital markets, before we kind of jump all into the CMU and the union, could you from each of your point of views perhaps just tell the audience what you think are the real opportunities in the market today, where perhaps the risk-adjusted yield, as it were, I know that's an odd term to use in credit, but a risk-adjusted yield looks quite interesting. Is there a pocket? Because the oversupply of money from where we stand has driven investments that are being made now by institutions via these asset management vehicles, has driven some complexity, a little bit of leverage perhaps employed underneath.
Do you want me to start? So I'll give you two thoughts on it. One, just to follow up on the risk point. I think people focus a lot of the risk around liquidity. People focus a lot of the risks around sort of these irregular sort of bankruptcy regimes across Europe. It's quite complicated for these cross-border, intra-Europe cross-border deals to get financed in some cases because of the complexities around that. I think those are very well identified. I think one risk, just to comment on it, and it's one I focus on, is actually because the markets have changed so much, because the financing sources are diversified away from these bank-sourced, relationship-driven models, is one of the issues is actually staffing at companies in the capital markets or CFO type role. There's a new generation of kind of capital markets focused CFOs that are coming into the marketplace who are able to engage with large institutional investors like this and others to raise capital to have ongoing dialogue and access that market on sort of a regular sort of basis. You see right now we're in the growing pains of the marketplace, and there's very, very wide sort of performances by CFOs and management teams in Europe. And so one of the challenges I think we have here is the market's grown very, very sharply in the leveraged finance marketplaces, is actually getting the human capital in, not just on the sell side, not just on the investing side of the business, but actually in the corporates to manage that. And I see that as kind of one of the sort of the key risks, which I don't think people talk a lot about, but that sophistication with which to manage capital when you have this interconnectedness that we talked about. So that's the risk side. On the opportunity side, I think it's the one we talked about. If you look at Europe, for example, it depends on the geography, but 80 to 90% of the companies still are financed through the commercial bank marketplaces. The U.S., again, is the inverse of that. It's only 15 to 20% is intermediated through banks. We're not going to go to that model probably in this geography, but we don't need to do that.
Well, I mean, that's a broad market theme, but is it really an investment opportunity today per se? Because as from what Michael was just saying, there is an oversupply of capital here, and he's competing with banks that correct me if I'm wrong, and I'm paraphrasing you, but that are providing very cheap financing with fairly low underwriting standards. They are not flexible, but they are doing that.
Yeah. So I'm not the investor, but I'll give the third comment. So just about sort of the investability of the asset classes. So if you look at high yield, for example, in Europe, the average yield here is about 6%. You look at default rates in this geography, they're 0 to 1%. So default adjusted returns and spreads are actually quite wide relative to they were historically. And so I think in a world where, in Europe, where growth rate is anemic and outlook for inflation and any kind of monetary rate rises is very balanced, that represents a pretty good yield opportunity. And that's why you've seen the total return be pretty good over the last 5 or 6 years. And so I think if you look at the risk adjustment, I think that's why we're seeing so much demand in this product. Maybe some other asset classes are a little bit more riskier from a return perspective, but that's one thought for you.
Michael, is that what you're seeing in your side?
Well, what I was going to say was I always want to bring it down to a slightly more homely kind of level. And speaking as a sort of long-term leveraged financier, I find one of the most exciting things about the current era, and I suppose I date that from just after the crisis, but there was some rumblings before the crisis began. What I see is that for the first time in history, really, people who actually understand credit are able to raise capital from big institutional investors and invest it very directly in situations that they understand in a way that requires them to take responsibility for the decisions they make. And what I always found troubling with banks is that there were so many levels of decision-making, so many bureaucratic layers, so many reasons why this month we're not doing it, and last month we did it with, equal enthusiasm. I never found that the bank was the best place to provide finance from. And I really think that it's one of the most positive developments, and it's a fairly recent development. I mean, if I think of 2012, which was the year I spent actually trying to raise a fund with a US investor who eventually changed his mind, there were just about none of these organizations, none of these funds in existence. Perhaps one or two of the bigger ones like Alcentra and Ares and Hayfin had existed, I think, before the crash, and certainly came into their own after the crash in direct lending. But the sort of upstart funds that I was talking about really only came into existence about 2013. And they all seemed to come into existence at once. So suddenly the market was flush with new institutional money that had all been raised on the expectation of returns of 14, 15% unlevered. And they were cutting each other's throats. But that's just one of the things that happens when there's a bit of a shortage of demand and quite a bit of supply. And I don't think it was enough to discourage anybody from the next round of fundraising. And as we've seen, there have been a lot of very big asset managers who've come into this business in the last year, really cementing the concept of the direct lending fund, which is so salutary, I think, for the market and the people in it. For once, they don't have this dead weight of bureaucracy and overzealous regulation on top of them, plus the indecision of banks, which so often filters down to the people on the ground in a very negative way. So they don't know why they're being told to do what they're doing, but they have to stop lending this month or lend twice as much this quarter, whatever.
Okay. Are there any questions before we kind of shift gears into the more regulatory angle here? Is there any on
You didn't ask me
market
for
structure?
My best opportunity.
Your best opportunity? I'm sorry, Jim. Your best opportunities.
Thank you, Odi. Listen, I think that there is the herd mentality, and the way to make money in today's market, particularly in structured credit, which is what I do, is figure out how to bring solution capital to those who, ironically, are affected by some of those regulations, which we're going to discuss in a few minutes. I do believe that we get paid for complexity and we get paid for illiquidity, and whether that means being able to confy up with a global bank and underwriting 250 names and doing a bilateral reg cap transaction that helps them relieve their cost of capital, or if it's doing things like CLOs where we buy 100% of the equity in a CLO and we take advantage, frankly, of the fact that banks and insurance companies can only lend at the top of the capital stack. So I think there's a tremendous opportunity, provided you're working with the right people. And what I mean by that is what may be a solution to Credit Suisse is not going to be a solution to the Bank of America or to Deutsche Bank or to somebody else, because their balance sheets, they're the same rules that affect all these institutions, but the balance sheets are completely different. So somebody may be into securities lending, which may affect part of their balance sheet and the way they allocate cost of capital to others. So you can't expect to do better than everyone else by just doing whatever they're doing. And I think, you can't, as a result of that, or an example of that is there's no cookie cutter solution to bring capital to either insurance companies, banks, or for that matter, LPs.
Okay, I've spent quite a bit of time looking at the reg cap trades.
A lot of people
spreads, no, absolutely. Investors are very interested in it. It looked like a really interesting arbitrage. Spreads today versus 3 years ago. How much tighter?
3 years ago. Well, how are spreads today versus 3 months ago? Spreads today versus 3 months ago on a 160 loan transaction. European bank issued at LIBOR plus 950. A very, very good portfolio, similar of revolvers, just recently printed at LIBOR plus 1150. So it's a 200 basis point pickup. Why? Because at that given time, the market was very hot over the summer when the one bank issued it, and things got a little tighter. Obviously, the economy got. It was a risk-off
the Chinese
scenario.
wobble, yeah.
Exactly. And I don't mean to sound cryptic, but obviously these are very confidential transactions. I think a lot of people talk about reg cap trades. There's a big difference between buying what is a broadly syndicated reg cap trade from a bank that issues on a regular basis and one that you negotiate with one or two or three at the most investors in, and you do collectively a $1 billion transaction.
Your point is taken that it can move quite quickly, which is again a liquidity point, I suppose. But it is also to do with complexity. But well done, very very politician-like, not actually answering the question that I asked and posing your own.
3 years
it's
ago.
Fine. It's fine. We have a question from the audience. I want to go for that. So over there, just second row.
Can you repeat his question so I can answer it?
Probably not. I can't do that either. But so we've spent a lot of time talking about what's going on in the corporate markets, whether direct lending or broader corporate issuance. I was curious what the panel is seeing in specialty finance, whether small balance consumer or commercial, in terms of what are the opportunities there, and compare and contrast Europe and the US.
Ooh. Anyone? I don't have any view.
So
Maybe.
we have a very active consumer platform. I think the most interesting thing, we just finished raising a drawdown fund that invests over a 3-year period, and there's a 5-year harvest. And one of the pillars, so I'm not marketing my fund here because it's already closed, is in the consumer space, where we actually originate, and typically it's mostly in the U.S. thus far. It's finding really what are fintech type of players out there that can source consumer credit, whether they be consumer receivables, underwrite them like the old-fashioned underwriting standards, and then we warehouse and typically work with a bank like a Credit Suisse or a B of A or someone to finance the top of that. So we give them 20% credit enhancement, and they'll finance that until we eventually securitize it. It's a growing market in the U.S. The new regulation and capital charges in the U.S. for unsecured consumer credit make that an open and very ripe opportunity. Where's the big risk? The big risk, and the reason I mentioned the fund, is because anytime I mention consumer opportunities in Europe or Asia or anywhere that I spoke, people all ask the same thing about peer-to-peer lending. And the only thing I can tell you about peer-to-peer lending is if there's 100 people out there doing it, I'm sure 10 of them are going to do really, really well. I don't know about the other 90, but
Are you talking about the platforms or the investors?
Look, there's different cultural. There's obviously cultural differences depending on where you are. Certain countries in Europe are very historically less likely to default on debt than others. Obviously, we saw what the subprime crisis showed us in the U.S. I'm not convinced that the average U.S. person who's borrowing something over the internet is going to do something productive with the money or go to Vegas. So it all depends on the structure. It all depends on the underwriting platform and how it all works. So I honestly don't know.
Yeah, I mean, I don't know about the panelists, but I have some quite serious concerns about the complete lack of underwriting on these platforms, and the fact that anyone, even who has any semblance of doing any sort of credit analysis or any sort of underwriting, is incentivized on the back end anyway. So the entire incentivization is to grow the platform and to grow the amount of money that's being lent out, rather than actually doing the credit risk. So to me, it's a disaster waiting to happen. Any other questions?
From 81.
81 questions, okay. So let's move on to the Capital Markets Union. Just high-level thoughts and views before we jump into details. Starting with Mathew.
Sure, I guess. Sure. Is it my, yeah. So I guess one of the areas that we've been focused on is really about this sort of transparency around markets and really making things standardized. And so my experience in Europe, I've been doing this leverage finance and credit business here in Europe since about '98 or so, is that we saw fast growth in certain markets where we were able to standardize documentation in one instance, so we could create the largest pool of capital so that we could negotiate things that were important to investors: credit quality, the quality of the sponsor beneath the company, if they were a private equity sponsor, its strategy and the like. And so one of the areas that we're quite focused on is really standardized documentation. So we've done that broadly in the bond markets, whether it's investment grade bond markets or our high yield markets, and now it's allowed us to scale those deals very, very materially. If you look at really the last 5 or 6 years, I think it would surprise people. I just happen to know the data, but 9 out of the last 15 deals, about 60% of the largest deals ever done in leveraged finance were cross-border deals that came out of this region. So it would surprise people. So it's whether it's GTEC or the Altice financings or some of these very large financings for Virgin and Liberty and things like that. So that we're able to do that because of standardization around some of the documentation. Our real effort really the last kind of maybe 18 to 24 months is to really help standardize some of the documentation around our institutional loan product, because it has been very cobbled together historically in Europe, in part because of the regionalization from a bank perspective. So we've been really standardizing some of the documentations around the institutional loan product. And you've seen, the slides have moved on, but you've really seen over the last 2.5 years because of this, and in part because of this, we've been able to scale that marketplace. And so that's one component within the CMU that we're focused on that I thought we'd highlight for you.
And do you think that the regulations and the plan of actions and the initiative that the Commission has taken on, do you think that is it heading in the right direction? Is it enough? Are there big hurdles that they're not dealing with?
Yeah, we think it's heading in the right direction. I think where the frustration has been really kind of around the pace of that. And so I think generally, I think the types of folks we're working with, types of institutions, they kind of wanted to move a little bit more quickly. But I think is the focus, on that point is a very material one to move this forward.
Michael?
Well, I come to this with a slightly different viewpoint. I've always fought against standardization. And I guess now I find myself in the private placement business, where most of what we do is bespoke between us and the issuer. And of course, the reason we can do everything on a bespoke basis is that we don't intend to sell the paper. We hang on to it to maturity, even if maturity is 20 or 30 years in the future, and even if the exposure is $350, $400, $500 million. I can see the attractions of standardization for people who are underwriting deals that they then want to sell the institutional B loans to one market and high yield to another market and so on. I always found it very difficult when I was a leveraged financier to accept the standardized documentation that was being sort of pushed upon me by the LMA. And I note that LMA is trying to do a similar sort of job on the private placement documentation. But that would probably hit the agented market before it hits the direct market, and we're mostly involved in the direct market. I have one observation to make on standardization. I think there's quite a lot of comment in the green paper that we've probably all read in preparation for today about standardization and the need for a common legal system and so on. And what I would say is that I spent 25 years in leveraged finance. I arranged deals across Europe for European private equity firms, sold them to European buyers or British buyers, etc. But the only law that we ever saw in the documentation was English law. And I think if you need a standard legal system, you've got it.
Oh. Any disagreements on that one? Standard legal system to use the UK?
I don't necessarily disagree with that. I was going to say, if you look at, and you asked me broadly whether the efforts are working. If you compare and contrast, in the U.S. you have 10 federal agencies or government departments that regulate banks, insurance companies, and investment advisors, and then 50 individual states that can also regulate each one of those. And some of them are obviously much more onerous and much more difficult to deal with than others, and as a result of it, that's where the business goes. I think you have a similar situation in Europe. I know you have a broad effort to try to build up and open up these markets, but at the end of the day, I think when somebody's not looking at it from the outside and people are just working in their specific regulatory body, trying to regulate their specific constituents, I think a lot of things fall through the cracks, and the last thing I think you want in Europe is what you do have in the U.S., which is regulatory arbitrage. Yep. You've got people that are moving to certain states to be able to charge higher interest rates than others. You have people going for lower tax rates and There's a whole slew of things that can happen, and I think when you look at things like Solvency II and the onus it puts on insurance companies, and at the same time say you want to improve the securitization market. In the document itself, it says that if ABS issuance in Europe got to pre-crisis levels, you'd add 150 million euros of new money into the economic system in Europe. I just think somebody has to look at it holistically, and I don't think people are looking at it holistically.
I mean, just judging by some of the other, this is London, so there's an obligatory Euro bashing, I suppose, here. But listening to some of the other panels, there's I guess, concern that they're just not sufficiently centralized parties with the right kind of power and the right kind of outlook to make this work.
Well, I think one of the things it would have to achieve is something that I don't think the EU has even scratched the surface of, which is persuading the individual states to abandon their separate legal systems. I mean, they're all happy most of them are happy to give up their currencies. They're happy to give up control of their of most of what goes on in their countries. They're prepared to accept that laws will be sort of handed down from European lawmakers, but they still insist on keeping their individual legal systems. And I think a lot of them, even though they may not have had these legal systems for very long, will fight to the death to avoid having them just sort of deleted and replaced by one common legal system. And as a lender, I think that there's such a diversity within Europe of creditor friendliness or creditor debtor friendliness, that it's a bit of a minefield for people doing cross-border deals. And as so often happens in lawmaking, there are unintended consequences to many things that have been enacted for specifically beneficial reasons. For example, in a different sphere, countries like Germany have enacted very inflexible labor markets, so it's quite hard to fire people. But the unintended consequences, it's very hard to get a job if you're out of work in Germany. And in the financial world, you have extremely debtor-friendly countries, which make it very difficult for lenders to enforce security or whatever in those countries, which has the unintended consequence of making lenders less willing to lend in those countries. So I think whilst the Green Paper expresses a lot of very pious hopes, I think it's going to be a massive uphill struggle to create the level of unification that is needed for proper CMU.
No, I agree with that. I think the legal system and bankruptcy law in particular are just fundamental based on what we've seen. It basically everybody's always playing in the same countries. From an institutional investor point of view of what people are interested in investing in from the UK, it's always the same set of countries that's going into.
If you look at AIMFD, I think I got that right, the different interpretation in the various countries in Europe will actually dictate whether folks like me market my fund to institutional investors. And in effect, some of those countries, what they've done is they've actually done a disservice to the institutional pension industry in their particular country by making it so onerous for us to get approval to actually to market in their country. That can't be the intended consequence of what that act was for.
What you find also, if you look at the capital markets, so we've seen this, just again, the markets that I focus on, these leveraged finance markets, huge uplift in terms of activity and movement from bank to capital markets. If you look at it in aggregate, that is the story, but where you don't see it is you have not seen it in the periphery. So you've not seen it in Italy or Spain, which are very overly reliant, on bank financing and all the problems they had historically. So, credit and capital, I would argue, is still not getting to those companies. The dialogue has increased, but it's not happening as quickly as we like to see. And then also in Germany, I think for different reasons, just given the health of the corporates that would be naturally borrowing in the capital markets are more reticent to do that. And so there's real disparity depending on which country you're looking at. And so this uplift in capital, this marrying of growth and savings is not happening in some of the areas that are most in need of it. Say Italy and Spain, where unemployment and other things are real issues. So we're working quite a bit on those problems.
And that's what the Capital Markets Union is trying to address in some respect. And again, to just promote capital markets, make everything more efficient, get the capital where it's needed. Is it enough? And again, without the change in the legal system, without the change in taxation rule, is this going to work? Because taxation, they've got a little bullet point on it. I don't know if anybody caught that. It's literally like five words long and said action plan to follow, to harmonize taxation cross border. But legal system didn't even address that, or solvency, and I don't see how any of this works without that. It just doesn't make sense.
So we're going through the growth pains. You look at the new issue markets. About 20% of them are first-time borrowers. So these are people that have not gone to the marketplace ever historically before. So either in an acquisition context or refinancings, and you find it is a much more difficult process. One, from originating, structuring, documenting, and then two is from getting sort of buy-siders to invest in that. And so the structural complexity is great. And so the question is, how am I getting paid? For that complexity, and that's one of the debates we have on each of these transactions that we work on, and that ebbs and flows depending on what some of the risk factors are clearly in the broader marketplaces.
And any thoughts on, as we all did do a little bit of preparation, reading the documents, the documents that came out on September 30th, so a few weeks ago, hot off the presses as it were, on the initial steps that they've taken in terms of creating standardized securitizations and trying to simplify those so that to remove, as they say, the stigma of negativity. Jim's nodding, so I'll let you answer that. But also the Solvency II, and to be able to make it slightly more attractive to invest in infrastructure assets if you're an insurance company, because the capital charge is decreased. So it seems again a couple of positive steps. There were five bullet points, 5 action items that they addressed, including covered bonds as well. Is this the right place to start? Is it?
I guess I'll throw a question back at you. Do you really want an insurance company, a small insurance company in Germany, France, Brussels, wherever, to directly lend to an infrastructure project, or do you want them to buy a AA piece of CLO debt, which basically would need, 83% of its portfolio to default every single year for them to lose a penny of interest? If that's what you're saying.
I assume that's rhetorical.
No, it's not. It's not rhetorical. Well, yes, it is rhetorical. So I guess my point is, just like you mentioned before, it was at the very, very end. It said, and we'll also address Solvency II. Well, yeah. That'll obviously that's a pet peeve of mine, because I think they're doing a disservice to the insurance industry with Solvency II. I think what I did like about reading that is that they at least acknowledged that when done properly, and when there is the right underwriting of the credit, that asset-backed securitization works. It works because it helps to disintermediate credit. It helps give opportunity to people who could not have access to investing in particular products, access to that, and it also helps banks to turn over their capital. I'm not going to argue that you need the same type of consistency with underwriting and such, and documentation in private placements. I understand exactly where Michael's coming from. But when it comes to securitization, you definitely need standardization. And we saw that in the US back in 1992, 93, when they finally standardized the commercial mortgage-backed security industry. As a result of it, it's probably the best performing asset class other than CLOs through the financial crisis as a result of the standardization.
Yeah, and their initiative to label it as standardized, exactly. And so to remove any connotations of undue risk is probably.
So I think it's a good first start.
It's a good start. Okay. Any questions from the audience? As we're into specifics now. No, we've got one over there. You have to wait for the mic because of the recording. Yeah. Thank you.
Thank you. John Jones from Allenbridge Epic. I'm interested in the panel's views. Are you concerned at all about further instability in the Eurozone and the impact that might have on the markets? Everything seems to have calmed down a bit since Greece. Or have you still got concerns in that area?
Sure, I'll select somebody. Matthew's chomping at the bit to take that one.
Yeah, so yeah, it's something we focus on acutely. We saw very clearly what happened in 2011. Which was many of the global investors, pulled back. They couldn't understand the risks that were, inherent in this region because they're primarily politically driven. And so we saw huge capital flows out of this region. So there was no queuing up at the ATM or cash points to take capital out, but certainly in the large institutional marketplaces, huge fund flows, went back into that. So we watched that very closely. You dial on kind of 18 to 24 months after that very acute period, it was just the opposite, which is you look at some of the large financings we were doing, multi-billion financings, and some of the riskier areas within Europe, because US investors or global investors were broadly underallocated. And so we're looking to, how do I play the recovery here? And they stepped in a very, very large way. I'm just thinking some large financings we did for wind, for example, in Italy. So if you're a levered bet on the periphery, that was something where, I can't remember the details, we raised 8 or 9 billion euros in a capital raise just for that one borrower. You saw what happened this summer. So we were, so when it was very bumpy because of Greece, you saw the capital markets in this region seized up. And so we took a whole pause for what was probably 4 or 6 weeks from regular way activity. There was some small syndicated activity that's getting done, but the large activity had paused. We had some stability in July, and you saw volumes increase incredibly markedly, and then we had the China news. And so yes, we're watching it quite carefully. We look for this interconnectedness of these marketplaces, and so when there's an issue in Brazil or issue in Southeast Asia, what you find is it ripples quite quickly through these markets. And so that's one of the challenges that we have, is that the risk transfer seems to go quite quickly these days. And so we watch it very carefully, and so we're watching it.
Okay. Any just out of curiosity, for institutional investors, anything that you would recommend that they do from their point of view to try to take advantage of or guard against the types of fast movements that you're seeing?
What we're saying is, I think successful managers are really focused on credit quality and the quality of the management teams beneath these companies. And so what you find is when these markets tend to sort of overcorrect, and we saw that a couple times. We saw it in sort of the May-June period. We saw it again, recently around to the Fed issues. And then what you find is those deals have kind of snapped back in terms of performance. And so having credit conviction, and to the point that we discussed earlier, which is there's a real credit culture that's developing, which has accountability in this region, which is I do my work, I make my investment, I live with the consequences of that. And so I think a disciplined process is something else that aids that. And I think successful folks have done that.
Great. Anything to add from those? Pretty comprehensive.
Yeah, the only thing I would say is that, as Matthew says, with the right professional manager who does the right credit work, they're going to understand the difference between fundamental and technically driven price volatility. And the greatest opportunity for folks like us who invest in illiquid and complicated assets is for technically driven price volatility, and quite often that's what we've been seeing. There hasn't been a huge fundamental shift other than in the oil and gas and mining and mineral sector. So as a result of it, good managers who understand fundamental credit have been able to take advantage of that, and those are the people you want to put your money with.
Speaking from the viewpoint of a private placement investor, I would have to say that a lot of what I've heard from my left is Greek, if not double Dutch, although I'm sure it's perfectly true and reasonable within the context of these gentlemen's activities. The great thing about being a private placement investor is that you lend for the long term. You essentially lend to boring companies, which you spend a long time assessing before you do so, and you stick to them through thick and thin, and the vicissitudes of the financial markets are almost irrelevant thereafter. My problem with Europe has been that its economic performance has been pretty stagnant throughout the last 2 or 3 years. And when I survey my portfolio, I find the only companies that are going down and being downgraded within our portfolio, downgraded that is by us, not by external rating agencies, are those who have a heavy exposure to Europe. These are the companies who've followed the orthodox wisdom that you should export and invest abroad in order to bring prosperity. If they had stuck to their guns, to their knitting, and invested only in England or UK, they'd probably have been better off, which is a rather sad reflection for me. But it's true.
That said, the world is cyclical, so it might come back. Any further questions, as we're running fairly low on time? There's one up here in the front.
I wonder what the panel views are on acquisition of distressed debt portfolios across Europe. I have seen that there have been a lot of hedge funds and private equity funds that have been queuing up to snap distressed debt portfolios from banks or from other institutions. I come from Greece, and although I don't live there, but I have seen a lot of even hedge funds recently that despite the turmoil are waiting to acquire distressed debt packages. So I don't know if there have been any successful examples of such transactions in the last couple of years that you would know of.
It's got to be a question from Paulo.
So,
Yeah.
so let's.
Was that teed up at the end?
That was.
Yeah.
Yeah, exactly. Thank you. It's what Apollo was built on buying distressed debt in particular and turning around companies. On the credit side of the equation, we have a very big business that buys what we call non-performing or reperforming loans here in Europe. Typically, I think there's a big difference between going to a bank and buying, and a lot of times it's done by auction. The GE capital is really, it's not a distress, but a lot of it is auctioned off, and the best bidder gets it. And quite often, maybe they're paying too much money. I think that it's not about going to a bank, a dumb bank, and buying something at 2 cents because the bank has to sell it. I think a lot of people raised a lot of money in 2008 and 2009, thinking they were going to go to the Landesbanks or some of the other banks in Belgium or the Netherlands or France and buy these portfolios at pennies on the dollar. At the end of the day, these aren't that stupid. I think people like to pretend they're that stupid, but at the end of the day, I think you need to have the right type of structure to buy the right portfolio of assets. And typically what we've done in one of our funds is we've bought consumer servicing platforms in Spain. We've bought them in Ireland. We've got residential mortgage servicing platforms here in the UK. We buy portfolios of non-performing or reperforming assets, and we actually service them as well, and then we look to finance them and do that in our fund structure. I think there's an opportunity to do that. There's probably a handful of other people that do it like we do it. But the hedge fund who raises a couple of $100 million and thinks he's going to go to some small town in Greece to buy the assets of a bank because some guy's going to jump out the window, I think that's a pipe dream on those hedge fund investors. I really do.
Yeah, they're not. It's our experience too. They're not desperate to sell by any stretch of the imagination. They can hold on to these assets at this point. Any last? I mean, I've got zeros in red here, but any last questions? Okay. Well, thank you very much.
Thank you.